So I'm just chilling on this Sunday and my phone starts blowing up like crazy. Well, no. The Fed did not just drop mortgage rates down to 0.5% or 0% or 0.25%. What the Fed did was they cut the federal funds rate. This is the rate banks can borrow from one another overnight in order to help with liquidity issues and things of that nature. So what the Federal Reserve did is they came out and they cut it for the second time in just 2 weeks down to 0 to 0.25%. This is for short-term loans and short-term interest rates. It has absolutely no impact on what mortgage rates will do. And Fed does not control it. Mortgage rates trade like stocks trade. They react thousands of times a day to news because they are traded live on the secondary market, on different bond markets through mortgage-backed securities. Now, the reason why the Fed did this is because right now banks are really concerned about liquidity. So think of it this way. When you go to the bank, they deposit your money, the bank takes that money and they turn around and they lend it out. And they usually lend out about 90% of all the deposits they have. And the Fed is requiring banks to keep a certain amount of cash on hand so that they can meet their reserve requirements. Well, with people panicking and with people pulling money out of the bank and everyone goes to the bank to borrow money, what happens is banks get short on cash. And so what they do is they take assets and they can sell those assets or pledge those assets overnight to different financial institutions in the bank to then go ahead and raise money overnight to be able to meet these reserve requirements. The rate at which they borrow from one another is what's called the Fed funds rate, okay? And that's the interest rate they're dropping. So they're dropping the rate at which banks charge each other to borrow money overnight from one another, as well as what they just did is they've dropped the reserve requirement. This is super important because before Dodd-Frank, we did not have this crazy high reserve requirement. Now, yes, it should have been higher than where it was, but not at the level it is right now, because what it causes is it causes some big time problems with liquidity. So this is a brilliant move by Trump to try to stop and generate liquidity and inject a bunch of capital into the market to kind of ease some of the panicking. And so what you can expect are lower interest rates on your credit cards. You typically can hopefully expect a little bit more stability in the treasury markets and the bond markets, because with mortgage-backed securities, what basically happens is everybody wants to take those assets that they have and sell them to raise cash. Well, what happens is when you have tons of people going to sell mortgage-backed securities in the market, what does it do? It drives down the price and it drives up the rate, which is what we saw last week. We saw panic selling in the mortgage-backed securities market. And so you saw yields dropping. And what happens is that makes interest rates rise. So interest rates jumped 0.75% last week. So this is a brilliant move where the Fed's going to come in to help buy or create some of that bottom for this to kind of prevent this panic selling. So no, mortgage interest rates didn't drop. Yes, they are low. If you have further questions and want to know if refinancing is the right option, just shoot me a DM or go ahead and just shoot an email to us, team@modernteam.com, and we can just tell you what if it makes sense or not. And to be honest, we have probably about 150 people right now I have on an actual waiting list that as soon as rates hit certain levels where there's an actual benefit, I'll have my sales managers reach out and get contacted. So take care and happy Sunday, guys.